A stock split is when a company issues additional shares to shareholders by increasing the total by a specific ratio. Companies often choose to split their stock to lower its trading price to a more comfortable range for investors, and to increase the liquidity of trading in its shares. Most investors are more comfortable purchasing 100 shares for $10 as opposed to 1 share for $1,000. When a share price has risen substantially, many public companies end up declaring a stock split to reduce it. Though the number of shares increases in a stock split, the total monetary value of the shares remains the same compared with pre-split amounts, because the split does not make the company more valuable. A company's board of directors can choose to split the stock by any ratio. For example, a stock split may be 2 for 1, 3 for 1, 5 for 1, 10 for 1, 100 for 1. In the UK, a stock split is referred to as a scrip issue, bonus issue, capitalization issue, or free issue. Enjoy our videos? Like, subscribe and share. There are a few good reasons why companies go through the hassle and expense of a stock split. First, a company often decides on a split when the stock price is quite high, making it expensive for investors to acquire a lot of 100 shares. Second, the higher number of shares outstanding can result in greater liquidity for the stock, which facilitates trading. Liquidity lets traders and investors buy and sell shares in the company without too great an effect on the share price. That can help companies repurchase their shares at a lower cost, since their orders would not move up the share price of a more liquid stock as much, which can lead to significant savings. While a split, in theory, should have no effect on a stock's price, it often results in renewed investor interest, which can have a positive effect on the stock price. While this effect may wane over time, stock splits by blue-chip companies are a bullish signal for investors. Many of the best companies routinely see their share price return to levels at which they previously split the stock, leading to another stock split. Walmart, for instance, split its stock 11 times on a 2-for-1 basis between the retailer's stock market debut in October 1970 and March 1999. An investor who bought 100 shares in Walmart's initial public offering would have seen that stake grow to 204,800 shares over the next 30 years without any additional purchases. Enjoy our videos? Like, subscribe and share. A traditional stock split is also known as a forward stock split, and its opposite is known as a reverse stock split. A company carrying out a reverse stock split decreases the number of its outstanding shares and increases the share price proportionately, and the market value remains the same. A company might do this if its share price had decreased to a level at which it runs the risk of being delisted from an exchange for not meeting the minimum price required for a listing, or to make its stock more appealing to investors who may perceive higher-priced shares as more valuable. A reverse forward stock split is a special stock split strategy used by companies to eliminate shareholders holding less than a certain number of shares. It consists of a reverse stock split followed by a forward stock split. The reverse split reduces the overall number of shares a shareholder owns, causing some shareholders who hold less than the minimum required by the split to be cashed out. The forward stock split then increases the number of shares owned by the remaining shareholders. When a stock splits, it credits shareholders of record with additional shares, which are reduced in price in a comparable manner. For instance, in a typical 2-to-1 stock split, if you owned 100 shares that were trading at $50 just before the split, you would then own 200 shares at $25 each. Your broker would handle this automatically, so there is nothing you need to do. The tax basis of each share owned after the stock split will be half of what it was before the split. Don't forget to like, subscribe and share, and check out our other videos.